Hi, everyone, and welcome back to another show. My name is Tyler, and I'm with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data, and our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about options risk management and how you can use ORATS trading tools to analyze your risk. Before we get started, Matt, do you want to share your screen and go over our positions?
Sure. All right. We don't. I was traveling the last 2 weeks, so we don't really have any open positions here. But this is where I want to start to talk about the risk management. It's our positions tab, and the neat thing is that we connect with various brokers: Tradier, TD Ameritrade, soon to be Schwab, TradeStation, and soon Interactive Brokers. So when you click on those, your positions show up and they bring it in. I'm not going to show that today, but I'll show you my paper trading positions. But the neat thing is you get all your positions come in. They're minimized now. When I maximize them, I could see what these trades are. And then I can treat them as a custom position, or I could define them in various ways. So we have a straddle on, we have a short put spread, and then just a single put there. So what I'd like to do now is talk about when I think about risk management, what are we talking about? The first thing that when I had a market making firm where I backed traders, we always wanted to be called a thing called long units. And what that means is when the stock goes down and you're short a put, you always want to have a long put or a short stock position against that because you never know what's going to happen. Same on the up. When a short call position is on, you always want to be either long a commensurate amount of stock or long a different call. So those are just the numbers, the quantity. So, you have the days to expiration here. So I have a position, actually, I'll talk about an out of the money position that I have in SPY for now. It's a short put spread. It's done well. I sold it for, I'm just going to go over what all these mean. Sold for $1.35. The closer to the money put, the 486 was sold for 360. The 475 was purchased for 225. So a net credit. So I got money, $1.35, and now it's only has 12 days left, and it's only worth 9 cents. So that's what all these mean: days to expiration, quantity, mark, or that's the mid price. That's when they mark an option. That's what they mean by that. And so the mark is there. We also have these kind of funny terms, S%. That's our smoothing. So our valuation is within 1% of where the market is right now. So if I were to pull this up, I could see that the SMV, or our valuation, is 9 cents, and not just the price of the spread. So those are also things that you want to look at is the ORATS valuation. Now we have our forecasts and our distribution edges. Those vary a lot more, but the smooth edge is usually between 5% and -5%. Any questions so far, Tyler?
I think that's good so far. I think when you said options risk management, the first thing that came to my mind was the Greeks, right? A lot of traders use the Greeks to manage their risk. They say you got to be long delta, or I want to be long delta. What does that mean, and what do you think about that?
Yeah, good question. I mean, the first thing I want to say to that is the Greeks can be misleading. You always want to look at things like, when I started talking about risk, I started talking about units, and a unit is a put, a call, or a 100 shares of stock position. So those are the main things to worry about. And then you can start to think about delta, and then after you get delta, gamma, which is how fast delta changes, theta, which is how fast your position is going to change over a day, and vega, if your volatility goes up 1 point, what's your profit going to be? Now, this is a very small position. It's only worth 9 cents. So the most we can make on it is 9 cents. And the most we could lose is the difference between the strikes and the amount that we receive for this particular spread. So if I, again, pull it up and work on a trade analyzer, the max loss on this position is, about $1,000 here. So it's 486, minus 475. So that's 11 points. So minus the $9 is, just a little bit under $1,100. Okay, so that's the most I could lose on this particular trade. And so this is what's called a payoff picture. And as you can tell, this is quite far out of the money. Our short put is maybe you could see the stock price moving well. It's right over 486, and the long is 475. So quite far out of the money. On a distribution, it's way under 1% chance of it getting there. As a matter of fact, it's 98 points, so about 1.5% chance if you add up these distribution probability points down here. That's how we figured out. So this is, probably should buy this in, but I like to squeeze out a lot of that money before I sell it out. So now what we've learned so far is we've learned what our max loss is and what our max gain is. And I should also show something here as well. So in addition to doing a max gain and max loss for the term of the position, we also do a 3-day max gain and max loss. So the most we can make in 3 days is going to be $9. The most we could lose is 82. Well, that's a lot different from what we saw on the payoff picture. And the reason is over 3 days, the distribution of stock returns that we saw earlier in the trade are a lot narrower. So it's only, in 3 days, it's probably only between here and here. In 12 days, it goes all the way to here. This is a three standard distribution move in the stock that we're mapping here. And so that's why there's a difference in if you add up all of the max losses for a position and the max loss that we calculate as a kind of what could happen possibly, or most probably within a 1% chance over the next 3 days. That's what this max loss and max gain is. So do you get what the difference is there between? I know I haven't gotten to deltas yet, but do you know what the difference? You get that difference there, Tyler?
Yeah, so those two columns there, those are showing the max loss and max gain, not by expiration, just within the next 3 days, assuming a 3 standard deviation move in the next 3 days.
Right. What's the lowest within a 3 standard deviation move?
Gotcha. So that's like a realistic capture of your max gain and max loss.
It's a very good picture of it, and we know if something crazy happens, we could lose $1,000, but that's like a 10 standard deviation move or something in 3 days for that to happen. We're just showing that 2 ways. So when you talk about risk, there's a lot of ways to slice and dice it. A lot of things can happen. Volatility could rise, volatility could fall, but in this case, we're just doing what we call a slide. We're sliding up 3 standard deviations and sliding down 3 standard deviations. And we show you what your max loss and max gain is over that. And then we also then dive in kind of over the full length of the trade. What is your max gain and max loss? And then you could also just calculate that too in your head. It's the difference between strikes less the amount that you get. So that would be the max loss if it went really far. So that's what we have. in the first few columns so far. Now we're about to get to delta. So you good on that?
Yep.
All right. So what do we want? What do we want, Tyler, to have happen in the short put spread? Do we want the stock to go up or stock to go down?
I want the stock to go up. Right. It's a bullish strategy.
Right. So if you think about it that way, if we want it to go up, then the delta is long. So we're long delta. We want it to go up. That's how I kind of think about it. Okay. So we want this to go up. And in this case, it's very low delta. Like, because we're kind of ambivalent. It could go up a little bit, down a little bit, and it really is not going to affect it. So the delta is low. So, if the most it could go, if it goes up $1, the most we can make is $9 anyway. So it's 0.9, not even one delta. And then, so, again, we're looking at a very extreme example here, but, the gamma is really small. The gamma is how much the delta will change if the stock moves. And then the theta is how much you're making each day. So we're making, we have 12 days and we have 1.5 theta. It's not quite a straight line. If it were straight line, it would be, I don't know, 80 cents or something. But it's a little bit more theta today. And then as it kind of decays out, it'll be like 0 with 3 days left or something. But there's a little bit more than, so the theta change, it's not quite straight line. It will actually start to diminish because if it were straight line, like I said, only be like, $9 divided by 12. So a little less than $1 a day. Vega, if the volatility were to go up, the bottom one has some Vega, but it's really not going to change that much. So far so good on that, Tyler?
Yeah.
Okay. So just kind of continuing through this put spread. Again, I think what I might want to do is I might want to, now when we're getting into theoretical values, I'm going to hop off of this position and just pull up the XLU, which is just, actually that's pretty small too. That's only 15 cents. But why don't we check that out anyway? So XLU is kind of the opposite, right? So it's negative delta, meaning if we want, in order for this to make money, we want this to go down. So we're long and out of the money put. And then what I'd like to look at are the, we've looked at the Greeks. For this XLU, it's funny because it's opposite. So instead of being negative gamma, we're positive gamma because we own options. When you own options, you're positive gamma and you're negative theta. So it's costing us. And then, we're long Vega, we're long options, so we're long Vega. So now we're over to, okay, what about the valuations of this option? Is 15 cents, do we think that's fair? Do we think it's low? Do we think it's high? What do we think about 15 cents? So if I go to trade, we look at it in three ways. We look at it from a distribution, multiplying the distributions times how much you would be up at that distribution point. So that you can see it's a little small, but it's 1%, 0.9%. So we multiply 1% times, I think at that point we're along $35 or something. So you multiply those out, and then you net it out against the how much you would be down 15 cents on all these, and the distribution. If you add all those together, that it's an expected return calculation, happens to be 8 cents. So you can see that that's lower than the 15 cents. So that has negative edge there. The forecast edge is 20 cents. So you can see that the forecast edge has positive edge there. And the smooth edge is basically right on top. It's just rounding. So, our smoothing edge, often is quite close to what the market is. Just to see what the market is, it's 16 cents at 13 cents. So it's still 3 cents wide. But that's That's what the market is in this particular stock. So now, again, going through what all these mean: DTE, quantity, mark, day change. So how's it done today? What's the probability of profit? What's the max gain and max loss? And we have some mouse overs there. And the Greeks. And now the D percentages, that distribution that we talked about. F is we do a forecast of volatility of the implied volatility surface. We forecast slope, we forecast long-term vol, we forecast short-term vol. If it had earnings, we forecast that, and we come up with what we think the volatility would be. And so that's how we get our forecast. So we think the volatility would be slightly higher than what's going on in XLU right now. So again, looking at that trade, we think it's worth 20 cents with a slightly higher forecast edge. And we could see what that forecast edge is. If we pull this trade up and we go to the option chain, you could see more information on it. So it automatically goes to it, automatically pulls it up for you. So again, the bid ask is 13 cents at 16 cents. The mid is about 15. Our forecast, there's that 20 cents there. So it all matches up. There's that 3 delta. The SMV vol, or our smoothing vol, is 20.8. Our bid vol is 20.3. That's the 13. The ask is 21.3. So the mid is 20.8. So we're, again, our SMV vol is a line that we draw through it, and it's right on to the 10th of a percent here. And you could see, where is it? Okay, you can see how this line kind of mimics this skew that we have here. That yellow circle, that green circle is the option that we're long right there. It's in June. It's way out of, you can see it's way out of the money down here. And you can see the valuations of calls and puts. Calls are in cyan, puts are in purple, and this orange line is that SMV vol. So again, pretty accurate here. If you're ever trading an out of the money put or call and it's a wide market, you don't know the theoretical values. A good thing to lean on is this SMV value. That 15 happens to be the mid right now. Let's see. Yeah, like here's one that's off by 1 cent. It's 25 and 26 here. Right on, 1 cent off here. So good things to look at when you're trading, especially wider markets. And then the forecast can be off quite a bit sometimes, just because we're forecasting higher volatility. We're forecasting 22 vol in this skew, rather than what is the mid 20.8. So we're a little off from there. Does that make sense so far, Tyler?
It does, yeah.
Okay.
Yeah, I want to go. Yeah. Are you going to talk about the profit attribution next?
Yeah. So the next thing that we'll get to, well, first I just want to talk about reward to risk, because that's another thing. Like, we talked about that past SPY, and what's the reward to risk? So this thing's worth 15 cents, but we think we could make $447 on this potentially. So the reward is a lot higher than what we've paid for it, as opposed to the, like I said, I would probably close this out, because the reward to risk, so we could lose 1,000 by 9, so it's 109 to 1. So usually, this shows about portfolio risk. So this is probably something that we should close out. We'll probably close it out. So actually, this is close it out. Close it out, pay the offer, and send it away. I don't want to look at this one anymore, Tyler. All right. So that filled. All right. So yeah. So back to what Tyler mentioned too. The next thing that we're going to look at is profit attribution. So what profit attribution means is how much did the price of this option change from yesterday, and why did it change? Okay, there's a lot of reasons why it could change. So let's look at it. So the prior day it was 16 cents, so it's now 15 cents. So this isn't going to be that exciting of a thing. So what are the, in this case, Vega changed, Theta changed, And so, that RS, so the 1 cent kind of came from a difference between those two. So Vega went down, and theta or 1 day went by, and so this is how we figure out what we think the reasons are for making or losing money. My office mate came in.
One of the cool things here is that if you pull up the trade history, you can see these sort of in more detail, right? If the profit attribution isn't quite enough, say you want to see, another few days or a week more of history, or you want to see a graph of how those have changed, you can see that here. And you can also pull up the different Greeks as well.
Right. Right. So this particular, option, 15 cents before it was 17 cents. So it's been, gradually losing, as the market kind of grinds up. You could see the stock prices in gray, and the implied volatility is in blue. The blips are right at the close or right at the open when the markets kind of go wide. But so what you can kind of see here is theta is just taking this down, and delta is taking this down too, because the stock's going up. This is the long put, so we're losing money both on theta, and we're losing money on delta in this particular trade. And then we talk about things here.
If you want to see that visually, you can add the Greeks to that graph map.
All right. Yeah. So what Tyler's talking about is, you could go up to the top and you could add a study. Do you want to look at, what your delta was over time? So that's where it is right now. It's basically -3. And it was a little bit more back here. It's -8. Yeah, -8 back here. So you could see, right, how those Greeks change over time. And it's really important to get a background and get an education in Greeks, and then know the limitations of them too.
I find the trade history tab to be a great exercise in, if one of my positions, decreased in value, and I'm like, well, I don't know why it did. I go here and see, okay, well, I can see what happened to the price, and then I can also see what happened to all these Greeks. Like, sometimes you'd be surprised at how much the position can change, overnight, just because of the theta or the delta.
Right. Yeah. No, it's a very nice, it's a very nice tool for that. You bring up a good point. And again, the profit attribution has to come down to something, right? Why did it change?
Right.
Gamma as it relates to delta, delta as, on its own, theta on its own. There's a mark, if it got marked, at a particular spot where we thought was bad, we kind of compare that to the theoretical value, which is the SMV. I know it gets a little complicated, but we're trying to figure out, what's going on. Why did this make money or lose money? It could be undervalued. It could be more undervalued now. And so that's what that means. Vega, you probably understand that. Slope is a different thing. Slope is I think a real interesting study that we do is, did the relationship between the puts and the calls change? Did the puts go up and the calls come down? That could really change the value of a particular option. And some people don't look at it that much, but that's another risk in there. So, a lot of these analysis tools and the Greeks are risks of your position. So, so we had theta risk, we had delta risk in this small option, and this is how, obviously in this case it didn't affect it very much, but in other cases, we may see that those Greeks affect it more. And then it's good to see what and understand why the price change. Some people are long a call and the stock goes up but you'll see the price didn't go up. You say, wait a second. Well, delta is only one part of this. It could have been vega that came down. It could have been slope that changed. It could have been theta is greater than that. So it's not just delta. People just think delta, meaning I have a call, the stock went up. Did I make money or lose money? And this will tell you, what we break down all the Greeks to show you. So it's not only risk, but it's kind of a review that we like to do as well. So far so good on that, Tyler.
Yeah, very cool. I wanted to mention all these columns that you see in the positions are also columns in the option scanner. So you can scan and use these columns like max loss and the Greeks, probability of profit, and our theoretical values to scan and filter your option results. And then you're seeing the exact same thing in the positions. So
right, yeah, that's a good point. You could scan on these if you don't want too much data or what. Those are all scannable. So we're almost done with the positions. We just have now the day P&L. So in this case, remember it was 16 cents yesterday, this put, now it's 15 cents. We lost $1. So that's pretty easy. That's just how the mark changed. The overall from the cost from owning it, I paid 76 cents and now it's worth 15. So I've lost 61.50 is rounding for that. And then we also have a buying power effect. That's how much it costs for us to hold this. Again, it has something. It's not just $15. It's the amount you paid for it originally is what we're putting in here. And often it would be the minimum it could be is $37.50 just based on a margin calculation. So these calculations are good to know for this buying power effect is how much they give you in order to trade. So we try to calculate that so you can see how much you have left to trade, and we do these calculations. So that wraps up, Tyler. The what I think is the page that I spend the most time on is the positions. And what I do is I have these positions in front of me, and I also have things that I like to do that are what did I put? I put a straddle on in Spirit Aerosystems. This is this Boeing deal. So what I like to do as well is I like to then I want to get an alert if the profit's up or down. So I'll add 2 profits up and below. So if it goes up 50% or down 50%, I'll note that it's a paper trading, and then I'll just say exit if this happens. And then it also will only exit if it's somewhere near the width. So if an option really widens out, it's not going to just send off all these alerts. It only is going to alert you if it's a kind of stable market or stable market width. Now you might say 63 cents is wide, but this stock is pretty wide, so I'm going to be okay with it. I could change this to 2%, for example, and then it changes that slightly. So, but I'm going to keep it about 1.8 wide. And yeah, then I'll submit that change. It'll go over and you'll see an A there, and then I could mouse over it. So that's another way to manage your risk and manage your risk in a particular position. So that's a nice feature for risk management as well, Tyler.
Definitely. Yeah, we have a lot of great tools for risk management. It's very neat to see.
Yeah, well, that's we're a half an hour in. That's about what I wanted to talk about. Do you have any questions, or what do you think we should do?
I think that covered it. I was going to ask you a little bit about certain strategies that you mentioned the units at the beginning and being a market maker and wanting to always sort of have a covered option, right? Like if you go like a short put, you always want to have a long put sort of further out of the money to cover it, right?
Yeah, right. So if, I don't know, we'll pull up a Microsoft. If you just were to naked sell something, Microsoft's 412, so I'll sell the 400s for $6. So as you can see, it's just, there's, and it just keeps going. It doesn't stop there. I mean, it says the max loss is 6.79 right now, but it doesn't really, if something were to happen now, Microsoft's a pretty big company, but if it's just a smaller company, anything could happen, so, this could go down, indefinitely. So, there's, a ton of risk in this particular sale. Now, and you could go out and for a quarter, you could buy the 335s. And first of all, let's just send this.
I was curious as to how, like, you what kind of put do you look for? Like, how many are you looking at the number of strikes below it, or are you looking at the difference in delta, or the difference in the spread price, or what are you looking at to determine sort of where you set up your risk management for that trade?
Right. So, I mean, again, it depends on your outlook, depends how much the stock moves. So for Microsoft, that $6 is pretty juicy. It's trading 412, but I'd never do it alone. Right. So, we have $6,000 of buying power that is cut into, but let's do another, let's buy something against that. So you can see where your position is.
Yeah, that's cool.
And, so now you would buy something. Now you don't want too much theta, so you don't want it to be too expensive, like, for maybe 30, even 80 cents, it's all relative. So this is $6. I would consider 80 cents, pretty small amount to pay to protect this position, right? So, let's just see what that should fill. All right, so this is our paper trading. So good. The market makers behind the paper trading were nice enough to fill us. So then what we could do is group this strategy into a short put spread. Even though we trade it singularly, we could see how we're doing here.
Wow.
Yeah, and now we can see, and now we can see that our max loss for very little money has gone from infinite and 6,000 or something, right? To 3,000.47.
Yeah.
So this is a reasonable trade, and why don't we just call this our trade for for the week, and we'll keep an eye on it.
Sounds good. Right. Yeah, well, thanks for answering that, Matt. I was looking for more ways to protect my positions, manage my risk, and all that.
Yeah, and we'll do this management too. Well, I'd be happy to get 25% of this, and then if I lost 50, I'd probably get out of it. So if it gets me that far, so this is, we'll call this a paper. We'll call this the T hub, the Tradier hub. Paper trade for the day today, and we'll exit at this alert. So I'll watch this. This will be tracked. So when we come back, we'll see if any of these triggers. If not, we'll continue to monitor it.
Awesome. Thank you, Matt.
Yeah, thank you, Tyler.
All right. Yeah, we'll be back next week. Same time. We have some new tools that are rolling out, including a community tab and an economic calendar. So we'll show you guys those next week. It's going to be exciting.
Yeah, sounds good.
All right. See you guys again next week.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual actual live trades or positions. Such information is not intended to be financial or investment advice. Trader Inc. is the parent company of Trader Brokerage Inc. Trader Brokerage Inc. and Trader Inc. are separate entities with their own products and services. Securities products and services are offered through Trader Brokerage Inc. Trader Brokerage Inc. is an independent subsidiary of Trader Inc., all rights reserved, member FINRA SIPC.